Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, Sunday, June 22nd, 2025, we're jumping into the U.S. Forex market. And, well, it's quite a scene. We've got this potent mix, really, of big economic policy shifts and some pretty startling geopolitical news shaking things up. Our goal today, simple. Cut through the noise, give you the core drivers affecting currencies right now. Okay, let's unpack this. So first things first, let's get grounded with the numbers. Where are things trading? We see USD, that's around 1.150Z,
Right.
and GBP/USD, the pound, it's actually dipped below 1.350, and USD JPY, dollar yen, that's nudged up a bit near 146.76. Just looking at those figures, what's the immediate story they tell?
Well, right away, those numbers show a really interesting divergence. It's more than just the levels themselves. Take the euro, for instance, holding around 1.1500 despite everything. It suggests some underlying confidence there, even with this broader risk aversion watching over the markets.
Right, that flight to safety we often see.
Exactly. And that same risk aversion, it's hitting the British pound. That dip below 1.3500 isn't just about weak UK retail sales figures we saw. It's amplified because investors are nervous globally, and that nervousness often pushes money into the US dollar.
Okay.
And the dollar-yen pair moving up. That's partly the dollar safe haven appeal again. But also, you have to watch for potential unwinding of carry trades.
Borrowing low, investing high.
Precisely. Borrowing yen cheaply to invest elsewhere. When risk flares up like this, those trades often get closed out fast, which means buying back yen. But the stronger dollar demand seems to be winning out for now.
And speaking of risk flaring up, this is where it gets really interesting. We have this major geopolitical event. President Trump announcing successful U.S. strikes on Iran's nuclear sites. That's not just a news alert, that's a genuine market earthquake, isn't it?
Oh, absolutely. A huge market mover. The immediate reaction, almost instinctual, was a rush into safe haven assets. On top of that list, the U.S. dollar. It's just seen as the ultimate refuge, mainly because U.S. treasuries are so liquid and, well, perceived as stable.
But it's not happening in a vacuum. You've got countries like China, Qatar, Bahrain. They've quickly condemned the strikes. They're warning about catastrophic consequences.
Strong words.
Very strong. And those reactions pour fuel on the fire of investor uncertainty. Capital literally flees to perceived safety. It directly hits currency values. Oil prices spike. It all feeds back into sentiment. And just to be clear, we're simply reporting on these market reactions and global statements as they happened, impartially.
Okay, so you have this huge geopolitical shockwave pushing people towards the dollar.
Yeah.
But then there's the other big piece, central banks. Let's shift gears to the Federal Reserve. We got some pretty dovish comments from Fed Governor Waller, even hinting at a possible rate cut, maybe as soon as July. Can you quickly explain what dovish means here, and how big a deal is that kind of hint?
Sure. Dovish basically means signaling a bias towards easier monetary policy. So suggesting a rate cut is on the table. And yes, it's a very big deal. It signals the Fed might be worried about growth, or perhaps sees inflation cooling enough to ease up.
Now, these expectations of a rate cut, they create a totally different type of pressure compared to the Iran situation. Geopolitics pushes investors to the dollar for safety, right? But rate cut expectations can actually make the dollar less attractive over time because lower rates mean lower returns.
Right.
So now the markets are just laser focused. They're watching every single piece of incoming economic data, inflation, jobs reports, you name it, trying to guess the Fed's next move. It's this constant game of anticipation. Wow. Okay, so let me get this straight. You've got the escalating Middle East conflict driving money into the dollar for safety.
Right.
But at the exact same time, you have the Fed hinting at rate cuts, which could potentially weaken the dollar. How do traders even process that? These two incredibly powerful forces pulling in opposite directions. How's that shaping the overall feeling in the market? That's the fascinating part, isn't it? This really complex, almost contradictory dynamic. It's like the market's trying to step on the gas and the brake simultaneously. The Iran situation is absolutely pushing funds towards the dollar and gold for stability.
Yeah.
You see that clearly.
Okay. But at the same time, those Fed rate cut whispers are putting downward pressure on the dollar's longer-term value. It influences how people think about holding dollars versus other currencies down the road. So the market isn't just reacting to one thing. It's constantly weighing these two powerful, often opposing forces.
Which must mean more volatility.
Exactly. Increased volatility. Sentiment can just flip on a dime based on the next headline, whether it's geopolitical or a new piece of economic data. It's a real test of how investors perceive risk versus opportunity, almost moment by moment.
So what does this all mean for you listening?
Well, I think today really shows that market moves are this constant, complex dance. It's between unpredictable world events and those very deliberate central bank decisions. It's never just one single thing.
That's right. This deep dive really highlights how fast seemingly distant events can ripple through global finance in really intricate ways. And it leaves us with a pretty big question, doesn't it? In a world shifting this quickly, with everything so interconnected, how does that balance keep shifting? The balance between seeking stability, like in safe havens, and reacting to strategic economic policy decisions. How does that continue to reshape the whole investment landscape? And maybe more importantly, what does it mean for how we should all be thinking about risk and opportunity?